Hey, I'm Ray Kang. I'm a commercial real estate advisor here in Central Texas. I work with landlords and owners and investors of strip centers. And what I focus on is property specific advisory so that my clients can make better returns on investment and help them understand what's happening in the market so they can make better decisions and ultimately, again, better returns on their deals. This show or this weekend retail wrap up is exists to keep an eye on what's going on with the US consumer and retail so that you don't have to dig through dozens of reports yourself. So, what we start off with is some macroeconomic news, also what's happening in retail, and then some advisory points that I like to share with investors. So let's start with the economic news because everything in retail starts with the consumer and the job market. So unemployment is relatively low, around 4.4% in December, but it was a tough year for job seekers. Hiring slowed meaningfully in 2025. Employers added just 50,000 jobs in December, and most of that hiring came from restaurants, healthcare, and social services. One data point that really stood out to me: involuntary part time work jumped 21% last year, meaning over 5 million people want full time jobs but can't get them. And that tells us the labor market isn't really falling apart or breaking, but it is loosening up. Wages are growing about 3.8% year over year, which is finally outpacing inflation, and layoffs are still relatively low. So households have a bit more breathing room, but job security still feels a bit fragile. Now, the second labor signal is layoffs. Initial unemployment claims are still low, around 208,000, and the 4 week average is the lowest in over 18 months. Layoff announcements also slowed in December. That said, 2025 still saw over 1.2 million layoff announcements, the highest in 5 years. And that's across tech, retail, warehousing, and business services. So while the pace of cuts has slowed recently, last year quietly reset expectations around job stability. The third piece is business activity. According to the ISM data, Institute for Supply Management, services activity picked up in December at the fastest pace in over a year. That includes restaurants, retailers, and financial firms. New orders improved, and hiring in services increased for the first time since spring. At the same time, manufacturing is struggling. Factory activity fell to its lowest level in over a year, pressured by tariffs and shrinking product demand. So the picture is a bit mixed, but overall, the economy is still standing on solid footing, led by services, while goods based sectors lag. Now, before we move on to the retail news, quick notes on a partner of the channel. Share Scoops is an AI powered financial content platform built to help advisors and financial professionals communicate more clearly and consistently with their clients. They help turn complex economic and market data into content that's approachable and useful without spending hours every week writing or chasing headlines. If you're an advisor, broker, or institution looking to build trust, stay visible, and educate clients more efficiently, they've created a discounted sign up link for my audience that you'll find in the description. So check them out. Now let's go into retail because this is where the economic backdrop starts turning to very real estate decisions. First, looking ahead into 2026, I was reading through this retail dive piece on retail trends to watch, and the tone is very different than what we heard a couple of years ago. Retailers are no longer focused on growth for growth's sake. The emphasis now is on profitability, discipline, and efficiency. And that shows up in a few ways. Retailers are slowing store openings, tightening prototype sizes, and being much more selective about locations. Omnichannel still matters, but stores are being judged more heavily on whether they actually pull their weight, both operationally and financially. For landlords, that means demand is still there, but the underwriting is getting tougher. Retailers are asking harder questions about trade area quality, traffic patterns, co tenancy, and occupancy costs. The bar hasn't gone down, it's actually gone up. The second piece I want to talk about is something that's getting less attention but matters a lot: international retailers entering the US market. According to this article from Shopping Center Business, international brands, particularly from Europe and Asia, are increasingly viewing the US as a growth frontier, but they're not blanketing the country with stores. They're targeting proven retail corridors, strong suburban markets, and well positioned strip centers where they can test and scale their concepts. These brands tend to favor smaller footprints, clean sight lines, and strong demographics in centers that already have consistent traffic. For strip center owners, this is important. Even as some domestic retailers pull back or consolidate, new tenant demand is forming, but it's flowing to quality real estate. Well located centers with the right mix and visibility are seeing interest that weaker assets simply aren't. And now let's turn to capital and development. ICSC reporting highlights billions of dollars flowing into large mixed use projects and institutional scale developments. You're seeing legacy retail players and new capital groups repositioning assets into mixed use environments that combine retail, residential, office, and entertainment. Now, this doesn't mean neighborhood centers are being left behind, but what it does mean is that capital is concentrating around experience, density, and long term relevance. For everyday retail to compete, it has to be clean, convenient, and functional. The strip centers that best perform are the ones that serve daily needs, support service based tenants, and fit naturally into how people live and shop today. When you put all of this together, the retail story isn't collapsing, it's sorting itself out. Retailers are shrinking weaker footprints, expanding more cautiously, and reallocating capital toward locations that truly work. For owners, this reinforces a simple truth: good retail real estate is still very much in demand, but it has to earn it. So let me step back and tell you what my team and I have been working on lately. We recently closed a 14,000 plus square foot multi tenant strip center in San Antonio. It was an older vintage property that had been owned and operated by the same family since 1986. This was part of an estate planning decision. We priced it correctly, positioned it well, and marketed it to the right buyers, created multiple offers, and qualified the best one. We had a fast closing and a successful outcome so the seller could move into the next chapter of life. And that deal is a good example of what planning ahead really looks like. We're also currently looking for space in San Antonio and Laredo for Wing Bay. They are a growing wing concept. They're looking for 800 to 1200 square feet inline or end cap, no drive through required, with a heavy takeout component. We're also working with Buttermilk Sky Pie Shop, which are amazing. Looking for 1,000 to 1,200 square feet in a Class A center in Northwest San Antonio from Castle Hills to Helotes. So if you got something, please do let me know. And with Paris Baguette, we've secured store numbers 2 and 3 near the Rim and Stone Oak here in San Antonio. And we're continuing to look for sites in Castle Hills, Alamo Heights, and New Braunfels. Ideally, 3,500 to 4,000 square feet with patio availability. So beyond that, we're continually working with strip center owners on value creation through property analysis, planning, refinancing, leasing, and sale. So make sure to reach out if you have any questions. As we wrap up, I wanted to leave you with one belief I think a lot of retail property owners hold, often without realizing it, and that is the belief of stability equals value. If the center is leased, cash flow is steady, and nothing feels urgent, it's easy to assume the property is doing good or doing well. But the question I want to ask owners is your property truly performing or is it just surviving? Because stability doesn't automatically mean value. In many cases, it simply means the property hasn't been stressed yet. What I see consistently is the difference between static ownership and proactive ownership. Now, static ownership looks stable on the surface. Rents don't move much, expenses creep up, and decisions get delayed because nothing feels broken. Proactive ownership is different. Rents are measured against the market, tenant mix is evaluated intentionally, and lease structures are used to protect cash flow. Capital decisions are made before pressure shows up. And over time, those two approaches produce very, very different results. One property stays fine, and the other compounds value. So, the new belief I want owners to consider is this: performance, not just stability, comes from active management. That doesn't mean trading constantly. It doesn't mean chasing trends. It means staying engaged enough to know whether your property is keeping up or quietly falling behind. You should have continuous curiosity about where your property sits today and what small intentional moves can protect and grow value over the next 5 to 10 years. And that's how long term owners quietly win. And that's this week's weekend retail wrap up. If you want help thinking through your property, your leases, or your longer term strategy, you're more than welcome to reach out. And until next time, this was Ray Kang with the weekend retail wrap up.